Hi all and welcome back. Today's Business Tube session we're going to be looking at cash flow forecasting. Now one of the things I want to tell you guys is now we're looking at the different financial documents. Okay, so we're going to be looking at cash flow forecasting, balance sheets, profit and loss accounts and liquidity ratios. It's really important that you make sure you have a copy of the the formula sheet that I have made for you. You must make sure that all of the formulas that we use for all of these financial documents, that you have revised and you have learnt every single one of those formulas, so that when you go into the exam you can do these without even having to think about them. So it's really, really important that you know what all of the formulas are. So basically we'll be looking at cash flow. Now cash flow is basically just shows inflow and outflow of cash into the business. Okay? Now, inflow is basically money coming into the business, and where would that be coming from? That would be coming from obviously selling products, but cash can come from anywhere. It's not just revenue. Cash can come from any source, such as loans, overdraft, selling an asset. This is money flowing into the business. Okay? Outflows is money flowing out of the business, and that will be what you're spending on things such as rent, stock, wages, electricity, salaries. This is money leaving the business. Okay? So the idea is we have obviously more money coming in than flowing out, because the inflow pays for the outflow. Okay? Now we have something that we call net cash flow, and net cash flow is basically the difference between those two. So some weeks we can have a surplus, which is a positive net cash flow. Inflow is higher than outflow, and sometimes we can have a deficit, which is a negative net cash flow when outflow is higher than inflow. Okay? Now, the idea in business is that we need to predict these deficits, because if we have more money going out than coming in, then we're going to run out of money. So the idea of a cash flow forecast is we're trying to predict, remember, it's called a forecast, we're trying to predict what is happening with our money coming in and out over a period of time. This is really important what I've got in here. So many profitable businesses have gone out of business because of difficulties with cash flow. Just because you're making a profit doesn't mean you won't run out of money. Okay? So remember, profit is calculated annually over a year, but you might run out of cash in March. If you run out of cash, you cannot pay anybody. You cannot pay your suppliers. You cannot pay your workers. So we must not run out of cash. Okay. What is a cash flow forecast then? It's just a document, it's a financial document that shows the movement of cash in and out of a business over a period of time. Okay, remember, it is a prediction. That's why it's called a cash flow forecast. So it's a prediction of money flowing in and out of the business over a period of time. And what are we trying to predict? We're trying to predict any negative closing balances. Okay, so receipts is inflow, expenses is outflow. So it's the prediction of expected inflows and outflows in the business over a period of time. Okay, and it shows our final balance. And remember, we're trying to predict any time when our cash balance might be negative, when we might run out of cash. Okay, we must not run out of cash in business. Okay, inflow, cash inflow can come from many, many sources. Okay, this is really important. You must not say a cash flow forecast shows profit. Cash flow forecast, all it shows, remember, is money flowing in and out of the business. Now the reason why it doesn't show profit, remember, what is profit? Profit is total revenue minus total cost. Well, a cash flow forecast shows money flowing in from many, many different sources. So from sales, this is total revenue, but cash can come from loads of different places. Okay, so investors, that is cash flowing in, it is not revenue. From lenders, the bank, that is cash flowing in, again, it is not revenue. Selling assets, so getting rid of an old asset, that is cash flowing in, but it is not revenue. Okay, so this is why a cash flow forecast does not show profit. Okay, it just shows, do we have enough cash? Because cash can come from many, many different sources, whereas profit only comes from total revenue minus total costs. Okay, remember, taking a loan, that is not revenue. That's inflow, but it's not revenue. You cannot take a loan for $1 million and say, I'm a millionaire, check me out, I'm rich, okay? Because if you take a loan, you've got to repay it. So cash flow forecast, really important. You must not mention profit. Cash flow forecasts do not show profit or loss. They just show inflow and outflow of cash. Outflows then. So these are payments. This is money flowing out of the business. This is when we're spending money. So this can be on wages, rent, salaries, electricity, okay, insurance, advertising, you name it. Anything that you have to spend money on, where money is flowing out of the business, that is a cash outflow. Okay, this is just a little example of, actually what did I come back to that one, okay. Net cash flow, this is really important. This is your first formula for cash flow forecasting. So net cash flow is basically the difference between inflow and outflow. So this formula, how do we calculate net cash flow? It's inflow minus outflow. On your exam, I don't know what terminology they will use. They might say inflow and outflow, but they may not. They may call it receipts and payments. Receipts are inflow, so payments are outflow. So net cash flow is receipts minus payments, or, same thing, inflow minus outflow. It's the same thing, okay? But I don't know what words they will use. So you just got to be aware of that. Okay, as we've already said, a business needs to make sure that they are predicting what is going to happen with their inflow and outflow. Okay, so cash flow forecast is a prediction. Remember, it is a prediction because it's called a forecast. This is not what definitely happened. This is what we think will happen in the future. Remember, if you fail to plan, you plan to fail. We have to predict. Okay, so it's the prediction of inflow and outflow in the business over a period of time. Now, this is a cash flow forecast. This is a prediction of what this business thinks is going to happen in January, February, and March. And here, they have predicted on their bank account, on their bank balance, that they are going to run out of cash. Now, the idea is that if you predict in the future that you're going to run out of cash, you can take action, you can fix this before this occurs. So if you predict that you're going to run out of cash by £5,000, you can fix it. If you think back to the previous business shoot, we can go and get a source of finance, okay? So we could go and get an overdraft. Remember, an overdraft allows you to go negative on your bank account. It allows you to go minus. So we could go to the bank and say, right, we need an overdraft of £6,000. That will allow the business then to cover this and just have a little bit spare just in case the prediction is not correct. Remember, this is a prediction, it may not be accurate, so we have to have a little bit extra just in case. So we can go to the bank and ask for an overdraft to cover this period of time. Okay? Remember, if you fail to plan, you plan to fail. If we predict we're going to run out of money, we can fix it. What we can't do is come to January and be like, I've got no cash, because then we're stuffed. We run out of cash, we can't pay suppliers, we can't pay our salaries, and then it's game over for our business. Okay, in filling out a cash flow forecast, the first thing that you need to do is you need to calculate the net cash flow. Now, in order to calculate the net cash flow, remember back to the formula, it's just receipts, aka inflow, minus payments, aka outflow. So receipts minus payments gives us the net cash flow there. So 1,500 minus 1,400 will give us a net cash flow of 100. And we just go across and fill this out. Okay? So this is our net cash flow. What I want you to think of this like, this is basically your bank account. This is what's coming into your bank account in January. This is what you're spending in your bank account in January, and this is the difference between the two. If we look at this column here, this is February. So this is the bank account, what we predict, what we think will happen in February. So in February, we predict that we're going to have £1,200 coming in. We predict we're going to have £1,200 going out, which means we have a zero net cash flow in February. Okay, March, 900 coming in, 800 going out, so 100. Now the opening balance is zero for this particular business. So basically, this is our bank account in January. Okay, we have 100, which is the difference between our inflow and outflow. We add that to our opening balance, which gives us a closing balance of 100. What I want you to do is think about these two here. Basically, the opening balance is what you have in your bank account on the very first day of the month. So the 1st of January, we had zero in our bank account. Throughout the whole of January, so from the 1st of January to the 31st of January, okay, so the entire month of January, we had 1,500 coming in, 1,400 going out, which leaves the difference for the whole of January of £100. So we started January on the 1st of January with nothing. Throughout January we had £100 net cash flow, so we add them together, which gives the closing balance on the last day of January. Remember, this is the closing balance is what do you have in the bank account on the 31st of Jan. So the very last day of the month we have £100. Now if we close on the 31st of January, if we have £100 in our bank account, then that stands to reason that on the next day, the 1st of February, we will have £100 in. Okay? If you go to bed on the 31st of January with £100 in your bank account, then you're going to wake up on the 1st of February with £100 because it's the next day. So basically, the closing balance becomes the opening balance for the following month. Okay? This month, we make nothing. We have a zero net cash flow. So net cash flow plus the opening balance, 0 plus 100, means we close February on 100. Okay? If on the 28th of February we have £100 in the bank account, that means on the 1st of March, the next day, we're going to open with £100. So the closing balance becomes the opening balance for the next month, if we look across. Okay? So I'll just go over those two formulas again. Net cash flow is inflow minus outflow. Closing balance is net cash flow plus the opening balance. Okay, just add those two together to get the closing balance. And the opening balance is the closing balance from the previous month. What is the importance of cash flow? Well, again, if we run out of cash, we cannot pay our bills, suppliers will stop supplying, our workers will stop working, we'll be taken to court, we run out of cash, and we're going to be bankrupt. Okay, we cannot run out of cash. Okay, let's have a look now at the advantages and disadvantages of cash flow forecasting. So again, we are predicting. Remember, a cash flow forecast is a prediction of what we think will happen in the future. So if we predict we're going to run out of cash, if we predict we're going to have a cash deficit or a negative closing balance, then we can take out a loan and we can fix it. If we know where cash shortfalls occur, we're going to try and avoid them, try and fix it. Okay? Maybe we could delay buying an expensive new piece of machinery. Okay? If we don't need that machine and we're going to run out of cash if we buy it, then it's a good idea to wait before buying that machine. Okay? It does allow you to compare actual performance with forecasts as well. Did we perform better than we forecast? Did we perform worse? The disadvantage, remember, a cash flow forecast is a forecast, it is a prediction, and nobody has a magic ball where we can see the future. So there are things that could happen that could cause our cash flow forecast to be completely wrong. Okay? Maybe a new competitor opens up next door. If a new competitor opens up next door, they'll steal customers and our inflows will go down. Okay? Maybe the economy goes into a recession. Maybe the country has a really bad state of the economy. We have a recession. Less people are buying products. Again, that will cause our inflows to go down. We cannot predict this. Bad weather could cause it. Maybe a change in trend. Maybe people stop buying our product. You cannot predict these things. Nobody predicted the financial recession in 2008. Nobody predicted the blockade of Qatar. You cannot predict everything. Okay, so maybe our cash flow forecast might be wrong. However, remember, if you fail to plan, you plan to fail. You should always do a cash flow forecast. This is one of the most important documents in business. Yes, you cannot predict everything, but it's better to have a go and try and predict and at least have something to work with. Okay? And what should all your predictions be based on? It should be based on market research. If you do proper market research, you can do accurate predictions, as accurate as possible anyway, to have a proper cash flow forecast. One of the things you do need to know, guys, is you do need to know ways to improve cash flow forecasting. This is really important. Now, you will get 0 marks if you give away, but you do not link it to either inflow or outflow. So all your suggestions, you must say that you're either trying to increase inflow or you're trying to reduce outflow. Obviously, you want to try and get the money coming in, going up, and the money going out, we want to be having less money going out. So how can we get our inflow up? Well, we can increase our selling price. Put your price up. When a customer buys a product, they pay more. That's more money coming in. We can advertise. Advertising creates brand awareness. Brand awareness will sell more. Debtors. If you've given your customers trade credit, which allows them to pay you back later, remember trade credit, buy now, pay later. If your customers are taking your product and paying you back next month, then get them to pay you back sooner. So reduce the trade credit to your customers. Get your customers to pay you back sooner. Or, inject cash into the business and get a loan. Okay, so get a loan from the bank, that will inject cash into your business. But any of these suggestions, you will get 0 marks, remember, if you do not link it to the fact that you're trying to get inflows to go up. The alternative, and I would recommend you choose one from there and then one from here, the alternative is you get your outflows down. Now to get outflows down, we need to reduce our costs. So we can make workers redundant, okay, or we could find a cheaper supplier. So remember, redundancy is when you can't afford to keep the staff. You don't have enough money, they haven't done anything wrong, but you have to let them go. So we could let some staff go and make them redundant, or we could find a cheaper supplier. Remember that you can evaluate this. A cheaper supplier though is going to reduce the quality of your raw materials, and making staff redundant is going to reduce motivation of your staff, okay? Or we could replace workers with machines. The alternative is trade credits. Now, trade credits to suppliers, do you want to pay your supplier soon, quickly, or later? Well, you want to keep money with you as long as you can. So increase trade credit, try and pay your supplier back as late as possible. Okay? The idea in business, you want to get money off your customers as quickly as possible, because that's coming to you, and your suppliers, you're paying them, so you want to delay payment to your supplier as long as possible. Okay? So they are the ways to improve cash flow. The ones that I would choose personally, okay, I would try and stay away from trade credit. I think it's probably the more difficult one to explain. Get inflow up by either increasing your price or advertising, get outflow down by reducing your costs. Nice and easy, keep it simple. Okay guys, that's cash flow forecasting, and I'll see you